Okay, this is timing strategies for Tuesday, July the 8th, for our client blog update. And what we did today is we removed the hedge on our long position, but we reduced our long exposure by a little bit. We had a hedge of, well, let's start where we were back on Friday of last week. We were long 20% Dow, 20% NASDAQ, 20% S&P. And 20% Dow, 20% NASDAQ, and 20% S&P, 20% long financials, and 15% long gold index, GDX, using the RIDEX family. We reduced the overall long exposure down to basically 30% long today, July the 8th, but we dropped the entire short spread. So we are now straight long 30% in the indices using the Dow, the NASDAQ 100, the S&P, the Russell 2000, and the S&P mid-cap 30%, and we are long 15% using the financials, and we can kind of use the XLF as a proxy also right there. What we also still have is a 15% long in the gold index. Use the GDX as a proxy there. Basically, that trade that we put on back here of 20%, we reduced it. We're now basically sitting about break even, upside down maybe 1/4% or 0.5% on the GDX. I anticipate that gold is going to do a little better. That's my anticipation. That's my estimation. Where would we stop out of that trade? Anywhere below this point. I think we're coming into some support right here. What I would like to see with the GDX, and what may get me long a little further from being long 15%, is all we need is a move back above and a close above the highs of today. The interesting point, and I'd like to see a close above the high of yesterday as well. What's interesting though, if you look at the GLD, which is the actual metal versus the paper stocks, has not corrected anywhere near as deep as the GDX. So here's the metal stocks. That's holding quite a bit better than the actual paper using the GDX. So there's a bit of a divergence. We only get the price of the paper. If we look at the XLF, finally we got a little something. And you know, the fact that Jim Cramer was so excited and jumping around like an orangutan that, you know, just lit off a bunch of firecrackers in his cage, starts to give me a little bit of doubt and hesitation and suspicions on the strength of this move, although I do feel that we should see the XLF come back up to at least test the low of that breakdown level that we saw back in March of about 22.25, 22.50. If we get back up to that level where we were just a few days ago, we'll renegotiate what we're going to do, if we need to do anything or change anything based on the closing price and how it negotiates or handles that 22.50 area. The spiders, well, we already told you what we did there. Again, we are long effectively the entire indice basket, including the Russell, of about 45%. That's with the financial exposure. Let me give you another look at something here. The mid caps using the MDY. That really took off, and I like that kind of action. Basically, our risk is going to be a close below the low of yesterday on almost everything for all the indices using the Qs. So if we get a close below the the S&P Midcap MDY below 140 effectively, we will reverse or go short. If we get a close on the Qs effectively below 2 days ago, below this low, basically below today's low, if we get a close below there, we will go flat or reverse. And then let's look at the diamonds for the Dow. It's kind of lagging. I don't like it. And again, so for the most part, our reverse or flat is going to be below the low of most of these days that we put in the low end today on. If we look at the spiders, that would pretty much come out to today's low as well. So a close below today or yesterday's low, a close below this point right here of Friday would probably get us flat again, or maybe short. What I am looking for, like I said in our previous posts, is I'm looking for a trade that's going to hopefully take out the high of that level on Thursday's high. If we can get a close back above there, or at least a test of that level, up into, and hopefully we get a, again, what I'm looking for, if you look at our previous post, what I'd love to see is a gap that takes out the highs of today's high, that does not trade below the low, or excuse me, that does not close that gap and trades back up into that level somewhere. I want to see a little fresh air between today's high and the next day's low, tomorrow's low. I don't want that gap to close. That would give me two things. That would give me this, number one, underlying sense that they're going to squeeze the shorts, and they're going to squeeze them hard. They're not going to give them a chance to get out. Number two, that would give me the confidence to hold that long up until our, levels that we're looking up here at 1335 on the cash, or 133.50 as our first level for the spiders, to start taking off that long position and maybe start looking to go short. So we'll see what happens. Worst case scenario, what would happen if the market did this instead, opened lower, and then just kept trading down, down, down? Well, anything can happen. And if that does, we may just go short again. This may be the first day of a one-day suckers rally that we saw today. I hope that's not the case. If it does, then more than likely we will reverse below a close below that line right there. I mean, that for this market to move, it's got to move like a rocket. It can't give too many people too much time to get in. Otherwise, the squeeze, the momentum, everything else is very questionable. Beyond that, please feel free to give us a call or send us an email. We'll keep you updated, or do the best we can to keep you updated. But as of today, we are long, effectively straight long for both accounts, the long short and the long only accounts. 45%, 30% in the indices, 15% in the financials, and 15% using the gold index precious metals. Okay? Have a good night. Wish you all well.